We're not robots, right? We individually are just at times as concerned and unsettled, and our feelings about the market may be similar to how individual investors might feel. But I do agree that we have maybe a better ability to override those feelings in the sense that we also can overlay our professional experience.
Hi, this is Matt Pauker with Wendy Lee. We're co-founders at Ivy Invest, and welcome to this week's episode of The Investment Office. As always, we're here to discuss the latest in private markets, alternative assets, and institutional investing. This week, I wanted to kind of key off your most recent Substack newsletter article, Wendy, which I think was really interesting in that you talked about a topic that a lot of individual investors face, but you faced in a kind of unique way in your last institution at the Mother Cabrini Health Foundation, which is this question of you've just got a big lump sum of money in cash. Do you invest it all at once, or do you dollar cost average over time? And for an individual, this might be the kind of question they face when, for example, they got a bonus at the end of the year, or maybe they inherited some money. You faced it in a similar, but obviously a much larger scale way at Mother Cabrini. $3.5 billion, I think you mentioned in the post that you started with at the outset of that foundation. So would love just maybe you can give a quick recap of the situation at Mother Cabrini and how you approached it, and then we can dive into some of the more nuances of both the math, but also, to your point, I think the psychology of this question.
Yes, that's right. So the Mother Cabrini Health Foundation started as a brand new foundation back in 2019. It actually officially was set up in 2018, but 2019 is really when the foundation began to build out the staffing across departments, when the portfolio began to take shape. So it was beginning of 2019, and it was actually $3.2 billion, and the majority of the assets were in treasury bills. So it was a brand new pool of capital. The Mother Cabrini Health Foundation actually came about because the Archdiocese of New York had created, let's call it, I guess, 25 years ago now, a nonprofit Medicare insurer, which started in Brooklyn, actually, but then went over the ensuing 2 decades or so to expand across New York State, and had grown to cover over 1.7 million people within the state of New York, and it became an acquisition target. And so it was, in 2018, acquired by a for-profit Medicare insurer, and that transaction generated, I think it might have been actually over $5 billion was the total sale. The New York State took a share of the proceeds, and that's how in 2019 the Mother Cabrini Healthcare Foundation come into existence with $3.2 billion in, like I said, effectively treasury bills. We were a brand new foundation. I was joining at the outset of the foundation. We, as the investment team, had the enormous privilege and task of building out this investment portfolio from what was effectively cash to a more diversified traditional endowment style portfolio, multi-asset class, multi-manager. There were a lot of different moving pieces in terms of how we wanted to build out the portfolio, a lot of different considerations in terms of how do you transition from cash to invested across different asset classes. And one of the, and I mentioned this in the newsletter, which you pointed out, one of the considerations that we had to take into account, which was, I think, on the face of it, perhaps a seemingly easy decision, but was actually, I think, we recognized as being potentially very consequential, was this question of, okay, well, of that $3.2 billion, we had determined that some portion of it would be the public equities portion of the portfolio. So that amount, let's call it more than $1 billion, less than $2 billion, that amount we knew we wanted to allocate to public equities. And the question at the time was, do we, because we know the allocation that we want to achieve, and we know that over time we would perhaps diversify into different types of public equity investments, but at the outset, to put on equity exposure, we started with some passive public equity exposure. The question was, do we put that exposure on right away, or do we average in over time, over some set amount of time? And the challenge here is that there are real consequences when you're talking about putting to work somewhere between $1 billion to $2 billion here.
Yeah, I mean, $1 billion is a lot of money. And obviously, I would imagine that part of the concern here, and you lay this out in the piece, is if there's a big market drawdown, for example, over the course of making this decision, right, that can have a huge impact, right? If everything is chugging along at 9, 10, 11% a year, let's say in the S&P, then it probably doesn't matter too much whether you put it all in at once or you average in. But a couple really good years or a couple really bad years could have had potentially a big impact here in terms of what a long-term returns look like, I'm guessing.
Yes. So that actually, this is actually what I talked about very specifically in the newsletter, is that in almost all circumstances, the highest expected value decision, meaning what is the thing that is going to give you the highest probability of the greatest return, that is almost certainly going to be put all your dollars at once into the investment that you want to make. And the reason I say that is because over time, historically, public equity markets, certainly the S&P 500, has tended to rise over time. And if you intend to be invested and you intend to be a longer-term investor, you are pretty much almost certainly going to see a higher dollar value from just simply the duration of that investment. Being invested for a longer period of time in a rising market is going to generate for you better returns. And so one of the things I broke down in the newsletter, and I used some very basic assumptions, which I won't necessarily get into here, but broadly speaking, it was if you were to look at the lump sum versus dollar cost averaging in over some set amount of time, and you were to look at how that portfolio performed over 10 years, being invested into the S&P 500, and you were to run this exercise on like sort of a weekly basis over some set period of time. I think I started from 1980 to present. The, again, highest expected value would have come from putting all the dollars into the market at one time. And like we as professional investors, we recognize that, right? Like we knew that the likely best outcome would be to put all our dollars into the market, knowing that this is the allocation we intend to make, knowing that we want to have equity exposure because the opportunity cost of not being invested is a cost as well. And we were conscious that, again, the greatest likelihood of the best outcome was to invest it all at once. That said, there is this sort of theoretical, expected value decision, and then there's the practical reality of what is the consequence if the other scenarios occur. Where
right, if you invested in the GFC, for example, right, and
precisely,
and all of a sudden overnight,
precisely, yeah, precisely. So we talk a lot about, yes, the greatest probability for the highest outcome is to invest all at once. On the other hand, as investors, we also have to be cognizant of the other potential paths for returns, right? So much of it is the end return and the end value of a portfolio really depends on the path of returns. And if, as an investor, you invest all at once into the market and the next several years happens to be a return path that looks like the GFC in ensuing years, the consequence of that is pretty severe. The consequence of impairing the value of that portfolio for a long period of time is quite severe. And so I talked a little bit in my newsletter about sort of theory and practice. Like in theory, yes, one might be the highest expected value, but in practice, the consequence of the next path, that next series of returns really does make a big difference. And so as an investor, and any individual investor has to make this choice for themselves. But certainly at Cabrini, we were very conscious that while we could accept a lower expected outcome than, sort of best case invest all at once, markets keep going up, while we could accept a lower set of returns in that scenario, what we couldn't accept, what was not for us an acceptable outcome, was if we invested all at once and then experienced a return path, a return series that looked like the GFC or any sort of significant market drawdown for any extended period of time. And so weighing those two, knowing that one was an outcome we could live with, one was if you didn't achieve the absolute best returns, we could live with that, and the other being a scenario that was just not acceptable to us, sort of saying that, okay, well, if you did happen to hit upon a period of time in which markets drew down for an extended and prolonged period of time, then that would really impair the portfolio, and again, not an outcome that we would take. And so that then, for us, led to the choice that we ultimately made, which was we knew how much we ultimately wanted to invest into the public markets. We laid out a period of time, and let's call it between 6 months and a year, in which we continue to, on a weekly basis, deploy some amount of the capital into the public markets until we eventually reached our target, which was also in combination with passive and at the time some active investments as well. So that was ultimately what we did at Cabrini. But as I mentioned in the newsletter, any individual investor would have to decide for themselves what is the risk they're willing to bear and what is the trade-off that they are willing to make in that decision process of lump sum investing all at once into the market if you know exactly what you want to be invested into and how much you want to be invested, or whether as an individual investor you would prefer to dollar cost average over time to minimize the potential risks associated with a prolonged drawdown and impairment. Although I will put an asterisk here, I think what I really think is very important to convey, and I don't think I actually mentioned this explicitly in the newsletter, what I'm not saying is that an investor should time the market, right? That actually is very explicitly what I'm not saying here, which is whether as an investor you choose to invest all at once, lump sum, or whether you choose to dollar cost average over time, the decision process here is one of proactive investing, one of not sitting on the sidelines, one of not determining when you invest so much as it's either, invest in the moment or invest over time in the near future. It's not wait a year or two and then decide, right? That almost always is not the right choice. The choice is almost always certainly don't market time. It is take advantage of the present moment, which is always a better moment to be investing than some unknown point in the future. That I can say with relative certainty. But the decision of how you invest into the market is really up to the individual. So just to be very clear, this is not a market timing. In fact, if anything, this is the how to avoid market timing. Taking one of these two approaches minimizes the temptation to market time, right? This is really all about you're going to be disciplined in either of these two choices, investing or dollar cost averaging over time. In either event, it is a disciplined approach and a choice that you're making and you're following through on. You're not trying to do some voodoo art of market timing, which, because no one can predict markets, is almost certainly not going to be a successful endeavor for folks.
Yeah, no voodoo magic. But I also think this actually speaks to a related point here, which is kind of the psychology element of all this, right? And which I think is perhaps a little different for an individual investor, versus you, and not to say that you all institutional investors are robots. You're people at the end of the day, but you're professionals. You're operating in the context of a set of investment policies and procedures, where perhaps you have the ability to be more dispassionate about how you're looking at investments and timing and so forth. Whereas, I think for an individual, there's a psychology element here that I think will come into play, right? Which is, how would an investor feel emotionally? It's their own money, of course, also, right? It's not a third party. It's not third party money, right? If you piled in all of that bonus money and, over the course of a few months, it dropped significantly, right? Like, I think that psychology would also be difficult for an individual and could also then downstream lead to some probably bad market timing decisions.
Well, it's funny that you say that, because you pointed out something that is very true, but I think I appreciate you pointing it out specifically, which is that investment offices, professional institutional investors are, at the end of the day, the investment teams are still made of individuals. Like, we're still people at the end of the day. We, at any point in time, may also feel that same level of discomfort with where market valuations are, or with volatility that we're seeing take place in the market, or any type of uncertainty from a macro standpoint. We're not robots, right? We individually are just at times as concerned and unsettled, and our feelings about the market may be similar to how individual investors might feel. But I do agree that we have maybe a better ability to override those feelings, in the sense that we also can overlay our professional experience. Some of us certainly have almost an inverse reaction to when markets decline, whereas because we've been trained to see that as opportunity as opposed to, being fearful in those moments. And so, there's some of that leads institutional investors and professional investors to perhaps not have some of the same maybe behavioral biases. But that's not to say that institutional investors, again, as people, don't also have behavioral biases. I think it's just more to your point, the frameworks that we put into place allow us to override a lot of those as best as we can, right? They create a sort of discipline that removes a lot of the temptation or decision-making that would otherwise be perhaps influenced by some of these behavioral biases. And so one of those, as you referred to, is just sort of this question about if an individual is looking at markets and saying, okay, well, I've got this bonus, or I've been saving this money for some amount of time and I saved this. It's very precious to me. Like, it took a lot of effort to build up this amount, and I do want to invest it, but markets feel rich, or valuations feel uncomfortable. And so I'm waiting for a better moment in time to invest. And I think, the challenge here is, as I was saying at the outset, the best time to invest to begin is almost always today, right? This current moment is almost always the best time to get started. That doesn't mean you have to, again, the whole point of this conversation doesn't mean you have to put it into the market all at once, but to dollar cost average and over time is a perfectly acceptable way of risk managing. Recognizing, again, it's all about sort of being disciplined and entering to the markets and not trying to market time or think that there's going to be a better entry point that as an investor you'll be able to predict. I say this in large part because, gosh, even thinking back to 2019, beginning of 2019, when we were deploying Mother Cabrini's capital, it felt like a very valuation-rich environment then too. And think about what markets have done from 2019 to today, right? And I would expect that in 7 years' time from today, someone will have been better off investing today versus trying to time it at some point between now and 7 years from now.
Maybe then we've talked now about the public side of the Cabrini portfolio, but I think there's also probably an interesting element here as you think about deployment pacing and timing on the private side, which is a little different. And we've talked about vintage year diversification before on the podcast. But one difference obviously in the private markets is that the set of opportunities that is available to you to invest in today is actually quite different than the set of opportunities that may exist in a couple years, unlike the public markets where you can invest in the S&P today, you can invest in the S&P in 2 years. And the makeup may look a little different, but broadly you're investing in a similar thing, right? Whereas as you think about private markets, whether it's private equity or private credit or venture capital, right? Like these are often funds that invest over a relatively short period of time, 2, 3, 4 year investment periods. And I think we've historically seen certainly that in these private funds that vintage years can be somewhat correlated, even across managers, and that obviously there is value in being able to invest across cycles. And so just curious to hear your thoughts about at Cabrini, again, where you were stepping into this big pool of money and you didn't necessarily want to sit on the private side of that capital forever. You wanted to deploy it, but how you thought about deploying that capital in the private markets.
We thought about deploying the capital in the private markets quite differently from the public market conversation we just had, right? We had done an exercise, what's called horizon modeling, for what it would look like, what the pacing might look like for us to reach our private markets target. And the pacing that we looked at that made the most sense for us as an institution and would get us to a place of reasonable diversification across the portfolio would take us about 7 years, was what we modeled based on the pacing that we were looking to deploy and the diversification that we wanted to achieve from both a vintage year perspective, manager perspective. And so that we knew at the outset would take us a much longer period of time. And to what you referred to, like in the public markets, the S&P 500 might look different 2 years from now compared to what it looks like today. But if you're invested in the S&P 500, your investment will shift to match, right, whatever that new composition makeup is of the S&P 500. That doesn't happen in private markets. There's not a dynamically shifting allocation of private portfolios unless you as an investor create one, right? And so the nature of building a private markets portfolio is one of you have to really be careful about maintaining consistent deployment over years because some vintage years do end up being significantly better than others. And so that vintage year diversification piece is important, just as important, I would say, as manager diversification or different types of exposure, diversified exposure within private markets. And so, there were a couple of things that we did. One, we did use secondary investments at the outset to help start and kickstart some of that deployment of capital into the private markets. We used those secondary funds to help us to establish some NAV in the ground to help mitigate the J curve, and then we continue to build upon the program with primary commitments to our highest conviction managers, again, deploying over multiple years with that sort of 7-year build out in mind.
And so just to make sure, to dig in, explain kind of what those secondary investments look like. So those are situations where you are actually buying in or buying parts of portfolios that were invested in years prior by other essentially limited partners, where then you are getting exposure to some older funds that have diversification, to your point, across both managers and vintage years.
Mm-hmm. So we were not buying LP positions, right? We were investing into secondary funds, and these funds run strategies where they are sourcing portfolios of LP positions or individual LP positions from large investors or small investors who, for whatever reason, are looking to monetize some portion of their private portfolio. So an LP makes a commitment, they are invested for some period of time, halfway through their investment, they want to monetize that investment, and obviously because these are private funds, the investment manager isn't able to just sell all of their positions at once and give the LP their money back. So if the LP is looking to monetize their position, they have to find another buyer that is willing to take their existing position, right? And so that's what an LP secondary is. So an LP portfolio that would include lots of different managers. They might be looking to sell some portion of their portfolio, and they might, pull out their investments into different managers across different vintage years.
And we've seen some of this in the news recently with some big university endowments, for example, looking to sell off portions of their portfolios.
Exactly. And so secondary funds will go and source these LP investments from institutional investors who are looking to sell or monetize some portion of their private markets portfolio. That's what's known as the LP-led secondary market. In 2019, that was still the majority of the secondary market were these LP-led portfolios. So what's changed since then actually is that the secondary market now is a lot bigger than it was 7-8 years ago. And the secondary market now today actually has a lot of what's known as GP-led secondaries as well. This is where investment managers themselves will look to structure a secondary investment of their portfolio. And so whether it's a single company or multiple companies within a portfolio that they're looking to structure in a secondary sale. And so the secondary market has evolved, but that's sort of a tangent. But the overarching point here was that in the case of starting a new portfolio, it was very helpful to be able to utilize these secondary investments and secondary funds to kick off that investment program in private markets.
Well, thanks, Wendy, for sharing the Cabrini story here. Obviously, again, the scale of the capital and the situation, very unique, obviously, even for an institution, but quite different in a lot of ways versus what an individual might face. But I still think a lot of lessons and valuable insights here for us plebe investors who from time to time may face these kinds of questions on a smaller scale. For those who haven't had a chance to check out Wendy's Substack, we'll include a link to the post in the episode description here, and certainly encourage you to subscribe and hear more of Wendy's insights. Thanks for joining us here this week on The Investment Office. We'll see you next time. The Investment Office is presented by Ivy Invest Corporation. Ivy Invest Corporation serves as the advisor for the Institutional Investment Strategy Fund, a closed-end interval fund. The fund is designed for long-term investments and is not intended as a complete investment program. An investment in the fund may not be suitable for you if you will need the money you invest within a specified time frame. Shares in the fund are illiquid and can be sold by shareholders only in the quarterly repurchase program of the fund, which allows for up to 5% of the fund's outstanding shares at NAV to be redeemed each quarter. Before investing, you should carefully consider the fund's investment objective, risks, charges, and expenses. This and other information is in the prospectus and summary prospectus, a copy of which may be obtained by visiting fund documents at ivyinvest.co. Please read the prospectus carefully before investing.